The official story of 2008 is a carefully constructed lie. They told the world it was about reckless families buying homes they could not afford. They were wrong. The real story is about a parallel financial universe, a shadow system that grew to become the largest unregulated casino in human history. It did not amplify the crisis. It was the crisis. And the pattern it revealed was ancient, repeating, and still unresolved. In the years before September 2008, the global financial system built a machine designed to transform risk into safety. Investment banks, hedge funds, money market funds, and insurance giants operated in this shadow realm, conducting the same functions as traditional banks: lending, borrowing, creating money, but without deposits, without regulation, without the backstop of government insurance. They called it financial innovation. History would call it the largest unregulated credit expansion in modern history. The machinery worked like this. Mortgages were pooled and sliced into tranches, each representing a different level of risk. The safest tranches were stamped with AAA ratings by agencies whose models assumed home prices would rise forever. These securities were fed into collateralized debt obligations, or CDOs, which repackaged the risk again. When demand for real mortgages could not keep pace, the system invented synthetic CDOs, pure bets on the performance of other securities, detached entirely from any actual homeowner. By 2007, the notional value of credit default swaps at AIG alone had ballooned to over $527 billion. The illusion was perfect. Institutional investors believed they held safe assets. Banks believed they had offloaded risk to vehicles off their balance sheets. Rating agencies believed their models captured default probability. Regulators believed the system was self-correcting. But the entire structure rested on one assumption: that real estate prices in Orlando had no correlation with prices in Laguna Beach. That assumption was false. When it broke, the machine detonated. This pattern was not new. In wartime Greece, occupation authorities printed drachma notes backed only by promises of future stability. The currency collapsed within months. In 14th century Florence, the Monte debt system created a perpetual funding machine. When tax collections faltered, it collapsed, taking major banking houses with it. In ancient India, the Maurya Empire collapsed after military expansion drained the treasury. The pattern repeats. Institutions create instruments they believe are immune to systemic failure. Then correlations surge under stress and prove them catastrophically wrong. The first cracks appeared in 2007 in the shadow economy. Bear Stearns hedge funds collapsed in June. By August, commercial paper markets began to seize. Investment banks, funding hundreds of billions through overnight repurchase agreements, found lenders unwilling to roll over loans. The repo market froze. Without access to Federal Reserve discount windows or deposit insurance, shadow banks faced a liquidity crisis with no safety net. The fall of Bear Stearns in March 2008 was not the earthquake, just the first tremor. The market convinced itself the worst was over. But a far larger institution was ticking like a time bomb. On September 15th, Lehman Brothers filed for bankruptcy, holding over $600 billion in assets. The decision not to bail out Lehman sent a signal. No institution was safe. Within hours, commercial paper markets collapsed. Money market funds saw massive withdrawals as the Reserve Primary Fund broke the buck after holding Lehman debt. Repo markets froze entirely. The contagion followed the hidden architecture of this parallel system, a web of counterparty exposures no single regulator understood. AIG had written credit default swaps on mortgage-backed securities with a notional value exceeding $500 billion. When rating agencies downgraded AIG on September 15th, Contractual triggers forced the company to post billions in collateral it did not possess. Goldman Sachs, Societe Generale, Merrill Lynch, UBS, all held massive exposure to AIG's swaps. The Federal Reserve intervened with an $85 billion loan, judging AIG too big to fail. The crisis revealed what regulators had failed to see. Shadow banks had replicated traditional banking functions, maturity transformation, credit intermediation, leverage, without the safeguards constructed after the Great Depression. Special purpose vehicles had moved trillions off bank balance sheets, but when markets froze, banks brought those liabilities back for reputational reasons. Opacity meant no institution knew its true exposure to toxic assets. And credit rating agencies, paid by security issuers, had awarded AAA status to over $3 trillion in loans that deserved junk classification. By October 2008, the system had collapsed. Treasury Secretary Henry Paulson proposed the Troubled Asset Relief Program, a $700 billion intervention. The Federal Reserve launched emergency liquidity facilities. Washington Mutual was seized in the largest bank failure in American history. Wachovia was acquired. Goldman Sachs and Morgan Stanley converted to bank holding companies, marking the end of an era. The system was rebuilt by government intervention on a scale not seen since the 1930s. The official narrative concluded with reform. Dodd-Frank imposed new capital requirements and stress tests to prevent another collapse. But the shadow economy adapted. By 2025, it has swelled to $239 trillion, more than double the entire planet's economic output. What nearly ended the world economy is now twice as big. The mechanisms evolved, but the risks remain. Repo markets continue as the primary funding source for leveraged institutions. Money market funds still promise instant liquidity on illiquid assets. Securitization now targets auto loans, student debt, and commercial real estate. The correlation risk that destroyed CDOs remains embedded in modern structured finance. 2008 revealed a predictable consequence of regulatory arbitrage. When traditional banks face capital requirements and liquidity rules, credit creation migrates to institutions facing none of those constraints. Shadow banks operate with higher leverage and greater opacity because they exist in regulatory gaps. When crisis strikes, governments face an impossible choice: allow systemically important institutions to fail and trigger cascading defaults, or intervene with taxpayer funds. The law of history is unbreakable. Systems built on hidden leverage always find their breaking point. They appear resilient during expansion, then become catastrophically fragile under stress. Beneath the surface, a deeper shift is underway. 2008 shattered trust in institutions that promised safety and delivered ruin. Central banks flooded the system with liquidity, suppressing interest rates to near zero for over a decade. But trust, once broken, does not return because regulators impose new rules. Individuals have begun questioning whether centralized financial systems built on leverage and opacity can ever be truly safe. Some return to hard assets no central bank can print into oblivion. Others turn to value built on mathematics, not politicians' promises. A system answering to code, not committees. The echo is not just regulatory reform, it is a revolution in how trust is constructed and where sovereignty is claimed. The victims were not random. Homeowners lost equity. Investors who trusted AAA ratings lost capital. Taxpayers funded rescues they never created. Workers lost livelihoods as unemployment surged. The crisis destroyed $13 trillion in U.S. household wealth, but not everyone lost. Survivors shared specific characteristics. Goldman Sachs received full payment when the government bailed out AIG. J.P. Morgan Chase acquired Bear Stearns and Washington Mutual at fire sale prices with government backing. Wells Fargo absorbed Wachovia. The largest banks emerged larger, more dominant, and backed by too-big-to-fail guarantees. Systemic crises concentrate power in institutions deemed indispensable. But the real victors read the history books. They understood the pattern before it broke. Knowing every system built on alchemy eventually explodes. Hedge fund manager John Paulson recognized mispriced subprime securities and bet against them, earning billions. Investors holding cash purchased distressed assets at historic discounts. Those anticipating central bank intervention positioned for asset price reflation. The lesson? Survival depends on recognizing fragility before consensus does. Those who survived understood wealth preservation begins with recognizing that systems built on leverage contain hidden fragility, and that sovereignty over assets provides protection when institutional promises fail. True safety comes from custody and clarity, not complexity. Institutions believing AAA ratings guaranteed safety discovered those ratings were paid opinions. Investors believing repo markets would always provide liquidity discovered correlations surge under stress. Governments believing shadow banks were separate discovered interconnectedness makes all failures systemic. Survivors held assets they understood, maintained liquidity buffers, and avoided leverage. When systems promise alchemy, history teaches the promise will be tested and fail. The crisis was not caused by subprime mortgages. It was caused by a parallel banking system replicating traditional banking without regulation or safety nets. By rating agencies selling AAA ratings to junk securities. By regulators believing complexity equaled sophistication. By a system so interconnected and opaque that no institution understood its exposure. The official narrative conceals the truth. Credit creation migrates wherever regulation is weakest. Shadow banking exists because traditional banking is constrained. When it collapses, taxpayers rescue institutions designed to avoid oversight. The system has not been fixed. It has been reflated and allowed to grow larger. The shadow economy now exceeds $239 trillion globally. The mechanisms that froze repo markets, money market funds, securitization operate at the financial system's heart. History teaches one law. Systems built on leverage, opacity, and institutional safety promises contain hidden fragility that reveals itself suddenly and catastrophically. What remains unresolved is trust. 2008 shattered confidence in credit ratings, financial complexity, and institutional protection promises. Central banks responded with unprecedented intervention, but intervention cannot restore trust, only delay the next reckoning. Individuals seek value beyond centralized control, assets answering to code rather than committees, currencies that cannot be debased. This is not finance rejection. It is a return to first principles, recognizing wealth begins with custody, not promises. When money loses trust, people rebuild it in gold or mathematics. The choice remains: accept centralized system fragility or reclaim sovereignty over value itself. History doesn't repeat, but if you ignore it, it will crush you all the same. If this analysis opened your perspective, subscribe to the Financial Archive to decode other patterns. The answers are in the past, and the warnings are written in the ruins of every system that believed it had eliminated risk through complexity.